Hi, good morning, class. Welcome to the next lecture of managerial economics, that is uh, lecture 14 of unit 5. So, in this lecture, we are going to have an idea of national income and how the national income of a country is measured. So, basically, we are trying to have a brief idea that what is national income about. For example, if there are five persons in a family and all five members are earning well. That means A is earning 10,000, B is earning 10,000, C 10,000, D 20,000 and E 20,000. So the total number of earning members in family A is 5. So out of 5, 2 is earning 20,000 and the rest 3 is earning 10,000. So the total income of family A is 20 plus 20 plus 30. That means 70,000. That means the total earning income of family A is 70,000. So now this example we can relate with the total income of the country. So when all the total number of goods and production is summed up or get total of a particular year, then the income which takes place that is known as the national income of the country. That means the national income of the country is that income which a country is earning in one financial year. Financial year means from 1st April to 31st March. So 1st April से 31st मार्च के बीच में कंट्री में जो भी इनकम एक्सपेंसेस हुए हैं गुड्स और सर्विसेज पे उन सब का जब सम टोटल होता है तो जो इनकम निकल के आती है तो वो कहलाती है हमारी नेशनल इनकम ऑफ द कंट्री. नाउ व्हाट आर द मेथड्स और by which methods this national income is going to be measured, that's we are going to discuss. National income is the total amount of goods produced within the nation during the period say 1 year. That means the total goods produced in 1 year is known as the national income once it gets some total. National income is also known as total factor of income, that is wages, interest, rent, the profit received by factors of production. That means factors of production which helps in the production of a particular commodity, that is known as the factor of production. And what are they? They are labor, capital, land and entrepreneurship of a nation. Now there are different concepts under national income which we are going to discuss in detail in this lecture. National income for the particular fiscal year or financial year. In India, financial year means the year from April 1st to 31st March. National income means the value of goods and services produced by a country during that financial year. So it is the net results of all economic activities of the country during a period of 1 year and is valued in terms of national income. So whatever the country is going to earn in the whole financial year, that is from 1st April to 31st March, when all those goods and services are get total, then we get the national income of a country. And in this all the economic activities are included. Economic activities means those activities which are related with cash or those transactions which takes place in the form of cash. Gross domestic product include government expenditures, consumption, exports and imports. Those things or those activities which are performed by the government on the basis of expenditure, consumption, exports, imports. So that is known as the gross domestic product. which are done on the part of the government. Gross national product or GNP of the country is measured by the income which is collected due to the various factors of production that are owned by the residents of India. Net national product is the market value of the net output of final goods and services which are produced by an economy during a year and net vector income for abroad. So these are some of the concepts of national income, or we can say these are the terms which are used in the calculation of national income. You should have an idea that what is GDP, what is GNP, what is NNP, that is net national product. Personal income is the income of individuals and all households of a country received from all possible sources before direct taxes. Disposable income is the income left with individuals after the payment of direct taxes from personal income. It is the actual income left which is used by the individual for consumption. For example, if there is a person known as Mr. A, he is earning a salary of rupees 1 lakh per month. So, how the national income of that particular or how the income of that Mr. A can be calculated. That means after paying all the taxes, all the expenses, if he is left over with the amount of 50,000, then the leftover income of 50,000 is known as the disposable income, and that 50,000 of income he can use for his consumption. So the leftover income of the individual for his consumption is known as the disposable income. Now these are the methods by which the national income can be calculated: value added method, income method, and final expenditure method. First is value added method. Value added method, also called net output method, is used to measure the contribution of an economy's production units to the GDP at market price. That means gross domestic product at market price. Here MP means market price. So value added method in which we are going to measure the contribution in an economy with the production unit, or you can say the total production takes place in the country is calculated by the value added method. In other words, value added method measures value added by each country in an economy. If anything is produced, how that produced commodity can add a value to the income of a nation, so that is known as value added method. For calculating national income through value added method, it is necessary to first calculate gross value added at market price, net value added at market price, and net value added at factor cost. Gross value added at market price refers to the value of output at market prices minus intermediate consumption. That means GVA can be calculated when from the value of output at market price minus the intermediate consumption. So the value which we get after the subtraction is known as GVA at market price. That means gross value added at market price. The value of output can be calculated by multiplying quantity of output produced by a production unit during a given time period with price per unit. For instance, if output produced by a production unit in a year is 10,000 units at price of rupees 10 per unit, then the total value of output would be 1 lakh. So this is the formula of calculating GVA at market price. Value of output. Value of output can be calculated from total sales plus closing stock minus opening stock. The value which we get is known as the value of output. Net change in stock is equal to closing stock minus opening stock. How much exact stock of a commodity which we are having till date, that can be calculated with net change in stock by minus closing stock with opening stock. Closing stock includes the value of unsold output in the previous year and forms the opening stock of the current year. जब हम बात करते हैं क्लोजिंग स्टॉक की तो हम पिछले साल के क्लोजिंग स्टॉक की बात कर रहे हैं और ओपनिंग स्टॉक की जब हम बात करते हैं दैट मीन्स वी आर टॉकिंग अबाउट द ओपनिंग स्टॉक ऑफ अ करंट ईयर. So, by deducting the opening stock from the closing stock, unsold output of the current year can be calculated. On the other hand, intermediate consumption refers to the value of non-durable goods and services purchased by a production unit from another production unit in a particular period of time. These goods and services used up or resold during the particular year or period of time. That means value of output can be calculated when total sales plus closing stock minus opening stock. GVA at market price can be calculated by using the following formula, that is GVAMP equals to value of output intermediate consumption. The word gross in GVA indicates the inclusion of depreciation. Depreciation means loss in the value of assets. Now, NVA at market price excludes depreciation from GVAMP. In other words, NVAMP is GVAMP minus depreciation. So the formula for calculating net value added at market price, when gross value added at market price minus depreciation. Depreciation means loss in the value of assets. कि किसी भी assets को जब हम continuation में use करते हैं तो use करने से उसकी value जो है कम होती जाती है. That means it start depreciating. For example, if we are using a four-wheeler and by by day that four wheeler is depreciating the value, क्योंकि जितना ज़्यादा आप यूज़ करोगे कार को उतना ज़्यादा उसकी जो वैल्यू है वो depreciate होगी. So the loss in the value of asset is known as depreciation, and when that depreciation is subtracted from gross value added at market price, we will get net value added at market price. Net value added at factor cost refers to another measure of value added. It is calculated by net value added at market price, indirect taxes plus subsidies. So this is the formula of calculating net value added at factor cost. So this is only the numerical portion rather than the theoretical portion. तो इसमें आपको ज़्यादा कुछ भी कंफ्यूज होने की ज़रूरत नहीं है. सिंपली you should go up with the formula that how the particular income is calculated. That's it. No numericals are there, but you have to go with the formula well. The following are the steps to calculate national income using the value added method. First, classifying the production units into primary, secondary and tertiary sectors. Whatever the production takes place or whatever the production of goods and services that are going to be considered, you have to classify that whether that production unit is related with the primary, secondary or tertiary. Second is estimating net value added at factor cost of each sector. Third, taking sum of net value added at factor cost of all the industrial sectors of the economy. This will give net domestic product at factor cost. So, estimating NFIA and adding it to national domestic product at factor cost, which gives net national product at factor cost, which is also known as the national income. So this is the formula of calculating the national income with value added method. Second is income method. Income method, also known as factor income method, is used to calculate all income occurred to the basic factors of production used in producing national product. Traditionally, there are four factors of production: land, labor, capital, and organization. So, income method means in this we are going to sum up all the income which is earned by the factors of production in a particular period of time, that is from 1st April to 31st of March. Accordingly, there are four factors payments, namely rent, compensation of employees, interest, and profit. There is another category of factor payment called mixed income. So, with income method, we use to sum up all the incomes which are used in the factors of production by labor, capital, land, and organization. And there are four factor of payments which is known as rent, compensation of employees, interest, and profit. It is also known as a income for the organization. These factor payments are explained as follows: rent, a particular amount which we are going to pay to a person after using his a piece of land or a building. किसी भी building को जब हम अपने purpose के लिए use करते हैं, no matter we are using it for commercial purpose or residential purpose, but we are paying a fixed amount of money to that particular person, and that is known as rent, and that is always paid in the form of cash. In national income accounting, the term rent is restricted to land and not to other goods such as machinery. So, if we talk about the rent, that means we are paying it with the use of land. In addition to rent, royalty is also included in national income, which is defined as the amount payable to landlord for granting the leasing rights of assets that can be extracted from land, for example, coal and natural gas. Yes, coal and natural gas is also performing on a piece of land, and we used to pay a certain fixed amount of money by for using that particular area. So that can be known as a royalty that we are paying, or the royalty that we are paying to the company for using the services in the form of natural resources like coal and natural gas. Compensation of employees. Compensation of employees means the amount which we are paying to the person in exchange of the services which he is giving to the company. Refer to the remuneration paid to employees in exchange of services rendered by them for producing goods and services. Compensation of employees is divided into two parts, as wages and salaries include remuneration given in the form of cash to employees on a daily, weekly, or monthly basis. It includes allowances such as conveyance allowance, bonus, commissions, rent-free accommodation, loans on low interest rate, and medical and educational expenses. So these are some of the things which become a part of the compensation of employees. Compensation of employees means the amount which we are paying in exchange of the services rendered by them for producing certain amount of goods and services during a financial year. Social Security contribution. It includes remuneration provided to employees in the form of social security schemes such as insurance, pensions, and provident fund. Interest. It refers to the amount payable by the production unit for using the borrowed money. If you have borrowed a certain amount of money, then as a form of security, you are paying certain amount of money which is known as interest. Generally, production unit borrow for making investment and household borrow for meeting consumption expenditure. In national income accounting, interest is restricted to the payment by production units. In production units, we are nothing to do with the interest. If production units use their own savings, then the interest is payable to them in the form of imputed interest. Profits. It refers to the amount of money earned by the owner of a production unit for his or her entrepreneurial abilities, whatever the abilities that he is using in the production of goods or services during a financial year. After giving uh, that commodity in the market, whatever the amount the person is earning, that is known as the profit. The profits are distributed by the production unit under three heads. First head by paying income tax called corporate profit. Second head by paying dividend to shareholder. And the third is the retained earning called undistributed profit. So profit is also categorized into three forms, that is income tax, what we are paying to the government, and if we are in a business then it is known as a corporate profit. Second is the dividend which we are giving to shareholders from whom we are taking some money. Third is retained earning, which is known as undistributed profit. So profit is the sum total of corporate tax, dividend and retained earnings. When all these retained tax, retained earning, income tax and dividend is sum up, then the figure is known as the profit. Mixed income. It refers to earnings from farming enterprises, sole proprietorship, and other professions such as medical and legal practices. In these professions, owners themselves assume the role of an entrepreneur, financier, worker, and landlords. Mixed income also takes into account the income of those individuals who earn from different sources such as wages, rents on own property, and interest on own money. So mixed income is the amount of income which is earned by the earning from different services in the form of profession like medical practitioner or the legal practitioner, or those earnings which takes place with the selling of commodities in a market like farming enterprises, sole proprietorship. So this is known as the mixed income. Therefore, national income, rent plus wages plus interest plus profit plus mixed income. Now let us discuss steps involved in estimating national income using the income method. Classifying the production units into primary, secondary and tertiary. Estimating net value added at factor cost of each sector. The sum total of the factor payment equals to net value added at factor cost. So this is the formula of calculating national income with the income method. The final expenditure method, it is the third method of calculating the national income of a country. Final expenditure method is also known as final product method, used to measure the final expenditure incurred by income units for producing final goods and services within an economic territory during a given period of time. So here you can see the very nice thing in calculating the national income of the country. That means इसमें आपकी तीन चीजों को बिल्कुल अलग अलग कैलकुलेट किया गया है. इनकम मेथड जिसमें हम सारी इनकम कैलकुलेट करते हैं, तो उसके लिए आपका इनकम मेथड है जिसमें हम ओवरऑल कितना हमने एक्सपेंस किया है country में, तो so the overall expenses done by the country that can be calculated with the final expenditure method, and the first is the value added method. That means those commodities which adds a value to the nation. So that is known as the value added method. So the third is whatever the expenditure which takes place in the production of goods and services during a given period of time, it is known as final expenditure method. These expenditure are incurred on consumption and investment. This method is the opposite of the value added method. This is because value added method estimates national income from the sales side, whereas the expenditure method calculates national income from the purchase side. This is only the basic difference between the two. So this table summarizes the calculation of national income by the three methods: value added, income, and final expenditure method. So this is all for this session. Now we will meet in the next session of the managerial economics. Till then, stay safe and be happy. Thank you, class.